Greetings from Kotak Mutual Fund. We are back with our annual market outlook. For last couple of years, we have been presenting to you how we see next year. There is no guarantee that whatever we say will happen, but it is important to put facts and factors which is going to shape coming year. Last year, a lot of things which we predicted came right. For example, Fed cutting rates, RBI easing monetary policy, equity return to moderate significantly, and most importantly, gold to deliver good return. Maybe last time we were lucky. If we look at the world right now, many countries are thinking of launching stimulus. As fiscal policy is going into overdrive, monetary policy is taking backseat despite Fed leading with rate cuts. Global growth will remain positive, but may slow down a little in CY26 over CY25. Key risks for the global market remains de-dollarization, return of inflation, is AI a bubble, and finally the US-China rivalry. We are seeing some unique things happening in the world. For example, a country like France pays more to its pensioner who is a retiree than the person who is actually working. Can this sustain? China is the second largest economy and racing ahead to be at par with US economy. Over last 2 years, CSI 300 index has done very well. However, if we see today's CSI 300 index, it's trading where it was trading 17 years before. In last 17 years, 5 times Chinese markets have gone up and crashed. Will China be lucky 6th time? If Chinese market corrects, undoubtedly global flows will go to alternate markets like India. We can learn many things from China's stupendous growth journey. They started by investing in real estate, and when they realized they have built more ghost towns than needed, they pivoted to industrial investment. Today, majority of solar panels, electric vehicles, robots are manufactured in China. While they have kept one leg in the future, the other leg is firmly in the past. They also manufacture shoes, garments, and other stuff. China has been investing for the future by taking leadership position in many critical technology. This is something which India must learn. China's investment many a times has happened without worrying about return. In a country where a lot of things are owned by government, that is probably possible. We'll have to balance between investment as well as return. The other interesting thing worth learning from China is their ability to make bureaucracy accountable. Bureaucrats who have not delivered up to the expectation are regularly getting sidelined or punished by China. US continues to remain world's largest economy. AI investment is pushing US growth rate on the higher side. However, the twin deficit, current and fiscal, is running into double digits. US government spending is substantial portion of their economy, and the twin deficits require large amount of borrowing. Din doguni, raat chauguni, US government debt keeps on increasing. It has now crossed $38 trillion. The real thing which we are looking forward is whether tariffs announced by Trump administration gets passed on to US consumer or not. Initial study do show that a large part of tariff will be passed on to the consumers. From our point of view, whenever dollar has depreciated, foreigners have taken money out of America. Collectively, foreigners own about $30 trillion of American assets, government securities, equities, and corporate bond. US dollar has depreciated by more than 10% this year. On $30 trillion of investment, they have already taken a hit of about $3 trillion. Will capital move out of America? CY25 was the first year after many years when emerging market outperformed developed market. If there are capital outflows from America, some amount of money will come to Indian market. Coming to Indian economy, there has been transformation from fiscal profligacy to prudent, clean banking system, inflation from double digit to low single digit, FX from crisis where we had to pledge gold in the early 90s to having fifth largest FX reserves in the world, infrastructure getting doubled in last 11 years, and most importantly, mindset becoming from tentative to confident. While India has a long distance to cover, undoubtedly a transformation has happened. We are now fifth largest manufacturer globally, ahead of industrialized nations like South Korea, UK, and France. Our per capita GDP is growing on purchasing power parity basis at faster rate than some of our Asian peers. Most importantly, this stupendous growth has been achieved by remaining fiscally prudent. India is the only major economy in the world which has reduced its debt to GDP ratio between subprime crisis and COVID crisis. The households and corporate India has deleveraged. Government of India to fund COVID expenditure has leveraged, but collectively India has reduced its debt to GDP ratio, which none of the other G20 countries have been able to do. This has been reflected into re-rating of Indian spread. There was a time when we used to borrow 6% over American 10-year treasury. Now we are borrowing 2.5% above US treasury. Whatever one says about India, opposite is also true. And nothing explains this better than our office in Bandra Kurla complex, Mumbai. When someone comes too bearish on India, we take them to one side of building, open the curtain, and show them Geo World Center and say, this is where one of the world's most expensive wedding was done. And HNIs from your countries were seen dancing in the Barat. Occasionally, when people come more bullish on India than us, we take them to terrace of our building, show them Dharavi, world's largest slum, and say that, look, here is a thriving, resilient slum, and that's also part of India. From the same building, we can make a bearish person bullish and bullish person bearish, because whatever one says, opposite is also true in India. US has unreasonably levied tariff on India. India pays more tariff than China on some of its exports to America. This is impacting sectors like textiles, aquaculture, handicrafts, and gems and jewelry. Undoubtedly, government has taken several steps to negate adverse impact of US tariff. The first is putting money in the pockets of consumers. 1 lakh crore tax rebate was given to taxpayers. GST rate cuts were announced, which is leaving 48,000 crore this year and next year 96,000 crore in the pockets of consumers. Interest rates have come down by 1.25% on $1.5 trillion outstanding loan. That's a saving of about 1.85 lakh crore. Eighth Pay Commission will put money in the pockets of more than 3 crore government employees across state, central, PSU, and local government. A ban on gaming was announced, which will save about 1 lakh crore in aggregate to the speculators. The government has taken steps to put money in the pockets of taxpayers, consumers, borrowers, government employees, and speculators. If these monies are spent on Swadeshi goods and services, undoubtedly India will continue to surprise on growth. The government is also negotiating with US on the tariff. US is also negotiating a peace deal between Russia and Ukraine. If that materializes, justification for levying 25% tariff on Indian imports will probably disappear. The government has also announced credit guarantee scheme to support impacted industry. Put together and finding alternate market for Indian exports, we should be able to overcome negative impact of American tariff. Overall, Indian economy is in a reasonable shape. It will remain fastest growing major economy. But there are challenges. One, central government capex with 8th Pay Commission recommendation coming into play will start flattening off. The private capex continues to remain on back foot even though there is availability of money. Capacity utilization is 75% plus and debt equity ratio of corporate India is one of the best. We have been given an opportunity as rupee has continued to depreciate against US dollar. This has created larger depreciation vis-a-vis yen, euro, renminbi, and pound. Can Indian exporter take advantage of this depreciation and export more to these countries? If that happens, growth will get supported. One more challenge for India is to ensure that this AI disruption does not take away jobs in its IT, BPO, and global capability center sector. About 10% of India's economy is dependent upon these three sectors, and they are vulnerable to AI disruption. In order to sustain growth, India must invest in research and development. Compared to peers, our investment in R&D is one of the lowest. There are some silver linings in the dark cloud. For example, a startup in Bangalore created a motor without any rare earth. We all know how China is leveraging its monopoly on rare earth. Such kind of innovation we need to push. Such kind of solution we need to market to the world. Overall, India will continue to grow in mid-single digit. It will be the fastest growing major economy, but it is unlikely to get into double-digit growth. Few things we are doing well, which is why mid-single digit best in the world will happen, but few things we are unwilling to do, and hence we won't grow at double digit. Notwithstanding all the challenges, on a purchasing power parity basis, India will contribute 9% plus to incremental global GDP growth in next 5 years. We are roughly about one-fifth of global economy on a purchasing power parity basis. From being coach to global growth train, we are now engine of global growth train along with US and China. Converting this into equity markets, markets are near all-time high, but many stocks are significantly below their all-time high level. About 73% of NSE 500 stocks are down more than 10% from their 52-week high. Large caps have fallen less, small and mid caps have fallen more. Indian markets have underperformed emerging market peers in CY25. This probably resulted into FPI selling continuously in CY25. Their holding now is about 15.6% thanks to relentless selling over last almost 5 years. Today, there is a tug of war going on between DII versus FPI and promoters. DIIs are buyer because of their call on long-term growth potential, last 1 year's underperformance. The FPI and promoters have been relentless seller. Maybe they looked at last 1 year's underperformance, valuation gap of India vis-a-vis others. Today, India has reached from excessive premium to its long-term average over China to just around its historical average. Undoubtedly, Indian markets now offer value vis-a-vis China. MSCI India Index valuation vis-a-vis MSCI Emerging Market Index from more than 100% has come down to about 67% against global average of 63%. Now we are trading vis-a-vis the world on historical average premium. Promoters continue to sell. IPO market, OFS market, QIP market continues to supply paper in the secondary and primary market. Earnings growth for last 6 quarters for Nifty 50 company was in single digit. We believe this is probably bottoming out. Next year, earnings growth are likely to bounce back into double digit. This will be driven by sectors like consumption, banks, and cyclicals. From a valuation point of view, Nifty 50 trades around its historical average, mid caps at a marginal premium, and small caps at a substantial premium. Investors can look forward to invest in equity based on their asset allocation call, but they must moderate return expectation and they must invest for long term. Last 5 years return in the market was about 16%, led by small and mid cap giving more than 20% return. If this is the investor's expectation in CY26, FY27, they are likely to be disappointed. Because 15 years before last 5 years, broad market return was 11% and it was driven by large and mid cap delivering double-digit return. Over 20-year period, Indian markets have delivered about 12% return, with large, mid and small delivering quite identical returns. Going forward, as our inflation has come down, as valuations are reasonable, investors must moderate their return expectation. What happened in last 5 years is unlikely to repeat in next 5 years in terms of return. On the equity fund management side, lot of reports suggest that active fund managers are not adding value. This is the data for Kotak Mutual Fund on rolling return basis. On a rolling return basis, majority of our equity and hybrid funds have outperformed benchmark index and added value to customers' portfolio. On a point-to-point basis, again, bearing few funds for short period, all our funds have delivered outperformance over benchmark index across equity as well as hybrid funds. If you look at SIP point of view, the same story repeats across majority of our funds, majority of time periods. We have delivered value to our customers by outperforming benchmark indices. Both active and passive fund needs to be present in your portfolio. But do remember, passive fund is most likely to underperform index. Active fund has probability to outperform index. At Kotak Mutual Fund, we are investing all our resources to ensure that we add value to our customers. From a theme point of view, over next 1 year, we think financial services with improving growth prospects offers good value. Consumer discretionary space also looks interesting as government has put money in the pockets of taxpayers, consumers, borrowers, speculators, and will put money in the pockets of government employees. As income level has risen, roti kapda will take lower spending and people will spend on discretionary spend, including healthcare. Banking and financial services, consumer discretionary space, including e-commerce and healthcare, looks interesting from next 12-month point of view. On the debt market side, despite getting the call right on the policy side for both RBI and US Fed, we have seen yields going up. We have seen our portfolios delivering negative return on long duration side. Fed recently cut rates in its December FOMC meeting. There were 2 dissents for not cutting and 1 dissent for cutting more. The divided Fed is still expected to cut interest rates well into 2026, maybe 2 times, maybe 4 times. This will put some sort of cap on Indian 10-year yield. Even in Japan, 30-year bond is reaching levels unseen before. Fortunately for India, inflation has come well below RBI's initial forecast. When we started the year, inflation forecast was about 4%. Now, inflation forecast for full FY26 is just about 2%. This lower inflation allowed RBI to cut rates in its December MPC meeting. They also pumped liquidity through open market operations and CRR cuts. Overall, RBI will be pro-growth and supporting banking system to deliver more credit to support Indian economy's growth. There is also likelihood of India getting into Bloomberg Global Aggregate Index. If that happens, we could expect a couple of tens of billions dollars in terms of flow. On the fixed income side, for people in higher tax bracket, Kotak Income Plus Arbitrage Omni Fund of Fund will be appropriate. About 65% will be invested into debt mutual funds and about 35% will be invested into arbitrage fund. This combination gives you stable return with less volatility. After 2 years of investment, applicable tax rate on long-term capital gain will be 12.5%. For high tax-paying investors, Income Plus Arbitrage Fund of Fund is most appropriate from a post-tax return point of view. We have been bullish gold since 2020. We were bearish gold between 2015 to 2020. In the recent times, we have seen some cropped video before 2020 getting circulated as if that's our view on gold today. I have put collection of my gold call over last 5 years in social media. My only request to viewers will be, please refer to our monthly outlook, annual outlook, or our multi-asset allocation fund allocation between debt, equity, and gold to assess our view. Don't judge us by viewing what we said 10 years before. That was appropriate probably at that point of time, but certainly may not be relevant at this point of time. On gold and silver, we continue to remain bullish, primarily driven by central bank activity. Central banks have been big buyers of gold, almost 1,000 tons a year, and the world is not having enough gold to meet both central bank and Indian housewife demand. Geopolitical tension, along with US interest rate cut, both support higher gold prices. Silver, apart from some buying by central banks like Saudi Arabia and Russia, there is industrial demand coming from electric vehicles and solar panel. The momentum in silver is very strong, so obviously there will be correction. But subject to those volatility, we remain bullish both gold and silver as long as central banks are buying gold and silver. If there is a manufactured gold or silver like lab-grown diamond, undoubtedly all bets will be off. When you are investing in gold and silver, do remember that there is no inherent value like dividend bonus rights. There is only perceived value. Hence, you should invest in precious metal within your risk limits and with a cap on your portfolio investment in precious metal. Whenever you see central banks selling gold or silver or manufactured gold or silver coming like lab-grown diamond, please knock off your portfolio. If I have to summarize what we expect in CY26, 1. Fiscal stimulus around the world, monetary easing slowing down a little. With this combination, global growth will remain positive but lower compared to CY25. In the fixed income market, RBI has scope for cutting interest rates one more time. The market yields are not factoring in RBI's rate cuts. A barbell strategy of putting money at the short end and some money at the long end will probably be more appropriate for CY26. Income plus arbitrage fund for high taxpayer and performing credit AIF for people looking for carry will be appropriate investment in fixed income market. Equity markets will witness higher volatility with geopolitical risk, but the return expectations will have to be moderated. It's a fair value market with neutral allocation. Large cap and mid cap looks reasonable. Small cap, one can probably remain underweight. FPIs have been sellers in CY25. Their selling intensity should come down in CY26. If we are lucky and there is outflows from American markets, we probably will see FPI turning buyers in CY26. Gold and silver, we remain positive. Obviously, returns next year will be far lower than current year. But invest in gold and silver within your risk limit and put a cap on the portfolio investment. If you see central banks selling or manufactured gold, silver coming out, dump your portfolio and move out of those asset class. CY25 was a year of moderate return other than in precious metal. Both equity and fixed income failed to meet investors' expectation. Gold and silver exceeded investors' expectation. CY26 is again likely to be a year of moderate return, with all the three asset classes, equity, fixed income, and precious metal, delivering positive return. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.